Will investing in the LIC SIIP plan help you create wealth in the long run? Let us find out through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. So a small warning, the LIC SIIP plan is not a mutual fund SIP. It's a ULIP named SIIP, so don't get carried away with that name. So before analyzing this policy, let us first understand a few basic details about it. So this is a unit-linked, non-participating, regular premium individual life insurance plan. Some of the key features of the policy are: you may pay premiums regularly at yearly, half-yearly, quarterly or monthly intervals. And there are 4 fund options available for investment, and guaranteed additions are also added to the fund value. And there are rider options available, and partial withdrawals are allowed only after the lock-in period. And there are benefits like death benefit and maturity benefit, and they also do give you additional benefits like refund of your mortality charges and guarantee additions. So if you want to know more about these aspects of the policy in detail, you can refer to the policy brochure for reference. So now let us take a look at the fund options available in this policy. So there are 4 fund options available, which are bond fund, secured fund, balanced fund and growth fund option. So according to the percentage of allocation they have to asset classes like government securities and short-term investments like money market instruments or listed equity shares, these funds are categorized based on this in the tabular column, and also according to the risk profile each fund option has. Also, as an ULIP, this policy has various charges. So it imposes various charges on you as the policy holder, like premium allocation charge, mortality charge, accident benefit charges if the accidental death benefit rider is opted for, and also like fund management charge, switching charge, partial withdrawal charge, discontinuance charge and miscellaneous charges. So from these charges only like some charges are justifiable, like mortality charge. This is for providing you with life cover, and also like fund management charge for basically managing your fund. But some of the other charges are unnecessary, like miscellaneous charges, charges for switching your own money and charges for withdrawing your own money. So if you consider and compare it with other market related products like mutual funds, for example, they don't charge these many frivolous charges. So this is a major drawback in a ULIP policy, and it also that's the reason it is very unattractive option compared to other market linked products. And there are advantages like your policy terms can be chosen as per your preference, and guaranteed addition will boost your fund value, and there are 4 options and you have the flexibility to switch between these funds, and riders can also be added to your base policy, and mortality charges are returned at the end of the policy term, and partial withdrawal helps to meet emergencies, and death benefit can be received in installments under the settlement option. So these are some of the advantages of this policy. The disadvantages, however, are the lock-in period is 5 years for surrendering and partial withdrawal. Numerous charges are in this policy, and the sum assured is too low, and a loan option is also not available. So the limited fund options available are, when compared to other ULIP products in the market, it is very limited. So these are some drawbacks that you need to keep in your mind before deciding to invest in this policy. Now, as we have a basic understanding of this policy, let us move on to the analysis part of the video, where we are going to calculate the internal rate of return (IRR) of this policy based on the figures given in the benefit illustration in the policy brochure. So here, for calculation purpose, let us assume that a 30-year-old male purchases this policy for a sum assured of 12 lakhs. The annual premium is 1,20,000 and the policy term and premium paying term is 15 years. So if the policy holder pays a premium for 15 years, then at the end of 15 years, he would be receiving the fund value as maturity benefit. So here the projected investment rate of return of this policy is assumed as 4% or 8% per annum just for calculation purpose. But these returns are not guaranteed, and it does not represent the upper or lower limits of what you could receive, because the value of your policy is determined by a variety of factors including future investment performance. This is just to show you how this policy can perform in worst and best case scenario, because this policy has market linked risk. So for the worst case scenario, IRR for 4% per annum is resulting in 1.80%, and the IRR for 8% is resulting in 5.53%. So the IRR for this policy ranges from 1 to 5%, which is not even comparable to a savings bank account rate of interest or even debt instrument returns in the best case scenario. So based on the risk and the long term time horizon we are investing in it for, it is the returns are not justifiable at all, because this rate of return is not sufficient to meet your life goals, and this rate of return is less than the inflation rate. So this can't be considered as a good investment choice. So what we are going to do is, now as this policy is not giving us a desirable outcome that we need, we are going to calculate and do a comparative analysis on the policy returns with other alternative strategy returns. So in this alternative strategy, instead of investing in an investment cum insurance like LIC SIIP plan, we are going to invest in insurance and investments separately to see whether it can give us better efficient returns in isolation. And for life cover purpose, we have opted for a pure term life insurance policy, which would cost us a premium of 4,500 rupees for a sum assured of 12 lakhs, which compared to the premium we paid for LIC policy was 1,20,000 rupees. So here the balance amount could be invested as per your choice. To demonstrate the return for equity and debt, we have chosen PPF as a debt example and ELSS for equity. So PPF account matures after 15 years and ELSS fund value at the end of 15 years is subjected to capital gains tax. So if you have any doubts regarding how the ELSS tax is calculated, we do have a small tabular column presented on the screen for your reference, which you can pause and see. So here in the final maturity value of the PPF account is 31.32 lakhs, and the IRR for the pure term policy plus PPF combination is 6.66%. So if you compare this returns to the best case scenario of the LIC returns, you can see that PPF is giving you guaranteed returns and even better returns than LIC policy in best case scenario, even because it is a government backed product giving you tax free guaranteed returns. Here the pre-tax value of the ELSS fund is 48.22 lakhs and the post-tax value is 44.51 lakhs. The IRR for the pure term policy plus ELSS combination is 10.67%, which is a post-tax return. So it's definitely an inflation beating return. The investment return is higher than the inflation rate. So accumulation of funds through these investments help you in achieving your financial goals, which is missing in the LIC SIIP plan. So what is the final verdict? Is investing in the LIC SIIP plan worth it or not? So this policy combines the features of insurance and investment. So when you pay a premium for this policy, a part of it is allocated towards the insurance component to cover the life insurance risk. So the remaining portion of the premium is invested in the chosen funds after deducting charges related to administration and fund management. So in case of the unfortunate demise of the policyholder during the policy term, the insurance component provides a death benefit to the nominee or beneficiary, or else at maturity the policyholder will receive a fund value based on the performance of his chosen funds. So the return on investment in this policy is not on par with other market related instruments. The risk and the return are not proportionate because it's not giving us a better risk adjusted returns for the risk we have taken and for the long term period we invest in it. So the yield should be greater than the economic inflation rate, otherwise the investment will not be beneficial for you. So the sum assured is also too low in LIC SIIP plan. But you may wonder why insurance agents speak highly of this plan to you. It is for the high agent commission that they get for selling this plan to you. So for life cover, buying a term plan with adequate life cover would be the right choice, and for your life goals you can choose invest according to your risk appetite.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.